the first exercise we have for the operating activity section, we're going to start with the net income of $280,000. So we start by listing that. So you have cash flow from operating activity. We list net income. So the first step is to list that we're going to be making adjustments to the net income to get to operating activities. So first thing we do are the non-cash items. So we have depreciation expense, and that will be added back to the net income because it's subtracted as an expense to get to net income. So we're going to add that back. Then we had a loss on the disposal of plant assets. So a loss is a reduction to get to net income. So we're going to add the loss back to get to the cash flow. So we are adding back the depreciation expense and the loss. So there's an addition of $82,000, which gives us cash provided by operations of $362,000. Our next example, E17-6, we looked at the comparative balance sheets for the company, and we have changes in non-cash current assets account. So we have accounts receivable, which is decreasing. We have prepaid expenses, which are increasing, and we have inventories, which are increasing. So we are using indirect method. Our net income is $300,000. So we start with net income. We're going to make adjustments to net income to get to the cash flow from operating activities. So our first line, we're going to adjust for the accounts receivable. So accounts receivable decreases because we collect more cash than we had sales. So if the accounts receivable decreases, it's because we collected additional cash. So a decrease in accounts receivable means there's an increase in cash. So we're going to add the change in accounts receivable because it decreased. Prepaid expenses increase. So if prepaid expenses increase, that means we paid cash to make the prepaid expenses go up. So that means there was a cash outflow. So we're going to subtract the change in the prepaid expense account. So there would be, inventory was next. So inventories increase means that we paid cash to make the inventory balance go up. So there would be a subtraction. The increase in prepaid expenses happens because we paid cash to make the prepaid go up. So it's a subtraction. When we total those three, we have a net positive. So the net income needs to be increased by $22,000 to come up with the cash flow. And there happens to be cash provided because the net number is positive. So there were cash provided by operating activities. When we finish the operating activities, so in this example, we had net cash provided by operating activities, we go and do in the investing and financing activities. So in this particular example, there was a purchase of a building, which would be an outflow, purchase of equipment, which would be an outflow. When you sell equipment after you're done using it, there would be a cash inflow because you're selling it and getting cash for it. So you add those together and you either have a use or a provision of cash. So there was cash going out, it's a use of cash. They issued common stock, so that means cash comes in, and when they pay dividends, cash goes out. So there was a net use of cash in financing. So when we take the $172,000 cash coming in from operating, the $141,000 of cash that goes out from investing, and the $9,000 of cash that goes out from financing, we have a net increase in cash of $22,000. We're going to add that to the beginning cash, and that gives us the ending cash for the period. So this is the cash balance that's showing on the balance sheet. So that's part of the articulation. This is our non-cash part of the statement. So non-cash investing financing. So they issued bonds, which is a financing activity, to purchase land, which is an investing activity. So there wasn't any cash involved here, but there was an investing activity and a financing activity that took place. So here is the net change in cash. The cash from 2016 to 2017 changed by $22,000. And that's what we're trying to explain with the statement of cash flows, is why that change took place. All right, the ratio in this chapter is the free cash flow. And what that is the cash provided or used by operating activities minus capital expenditures minus dividends. So it's the cash remaining after you've done your capital expenditures and your dividends. So it's the cash remaining from operations after you've done your investing activity and your financing activities. So in this particular example, this company reported cash provided by operating activities of $360. The cash used by investing activities was $250, and that included cash spent for capital assets of $200,000, and net cash provided by financing activities of $70,000. So dividends paid were $140. So they ask you to calculate the free cash flow. So we've got $360 from operating. We have $200,000 for capital expenditures and $140 for dividends. So you have to pull this information out. So net operating was $360, capital assets expenditures, so just the amount that's on capital expenditures, capital assets, and the amount paid on dividends. So there was $20,000 remaining, which is the free cash flow amount from the operating activities. That was the amount left over to be used on whatever they wanted. Okay, in the recent quarter, Alliance Atlantis Communications had net cash provided by operating activities of $45,600,000. They had revenues of $264,800. Don't really care. Cash spent on plant asset additions, so those would be capital asset expenditures, was $1.6 million, and there were no dividends, so the dividends are zero. The operating was $45.6 million, and the capital expenditures were 1.6. So 45.6 minus 1.6 gives us free cash flow of $44 million. So it's pretty straightforward. All right, so this is typically what you're going to have on the exam. So they looked at the comparative balance sheets, they looked at the income statements, they looked at the other general ledger account information. So we're looking to put this into operating activities, investing activities, financing activities, or non-cash activities. So payment of interest on notes payable. So all the interest payments and interest received are operating activities. The exchange of land for a patent, so there is no cash activity happening here, so this would be a non-cash investing and financing activity. And in this case, it's just a non-cash investing. It's an exchange of one investing asset and one asset for another asset. Sale of a building at book value. This is going to be just in the investing activity section because there's no gain or loss. It doesn't affect the operating activities. Payment of a dividend. This will be financing activity. And you have to be careful with the dividends. The declaration of a dividend, and this is just for cash dividends. It doesn't hold for stock dividends. So the declaration of a cash dividend does not affect the statement of cash flows because there is no cash. The payment of the dividend, there is a cash flow. The payment of a stock dividend, there's no cash flow, so it doesn't show on the statement of cash flows because it's just a distribution of a stock. Now, depreciation expense. We know that depreciation expense has no cash flow associated with it. So you would think it shouldn't show on a statement of cash flows. But if we're doing an indirect statement, it is a reconciling item in the operating section. So depreciation expense we're going to report as an operating activity item. Receipt of dividends on investment in stock, that's going to be an operating item. Receipt of interest on notes receivable will be an operating item. And the theory behind that is that it's a management decision about whether or not to make those investments. And so whether or not the company is receiving or paying interest or receiving interest on investments or dividends on investments in other companies is due to the management's decisions. Therefore, it affects operating income, affects whether or not they have those monies available, which is why it goes into the operating section. So issuance of common stock, that's going to be a financing activity. This continues, amortization of a patent. So amortization is a non-cash activity. So if we're doing an indirect statement, it's an adjustment to net income, so it would show in the operating section. Issuance of bonds for land. So again, this is a non-cash transaction, but we have a financing activity taking place for an investment activity. So this would be a non-cash investing financing transaction. Purchase of land, so assuming for cash, this would be an investing activity. Conversion of bonds into common stock. So we're giving up bonds, which is a financing activity, for common stock, which would have been a financing activity, but there's no cash here. So this is a non-cash activity, but it's important. So we're exchanging one financing instrument for another financing instrument. And then sale of land at a loss. So the sale of land itself, the cash flow for that would show in investing. The loss part of the transaction is going to show in the operating section. So because this is talking about the loss is part of operating activities. And then the retirement of bonds is a financing activity.